Now that we've made it through the first week of earnings season, it's time to go over what we've actually learned. This week, we got a bank earnings blitz with all the major financial institutions reporting, and they collectively painted what I think was a naboth. Yeah, not as bad as feared. To me, that's very encouraging, which is why I want to take them one by one. I want to spend some time on these because this is the best acting group in the market right now. Why don't we start with the big money center banks? See, if you have a long history in the stock market, you know that this should have been an awful quarter for the banks. Think about it. We've got this inverted yield curve. I know you're bored by it, but let me just walk you through it. So where long-term interest rates are lower than short-term rates in many cases, these rates control the net interest margin, the difference between what they make on your money and what they pay you for it. That's where all the money's supposed to be made. You'd expect the inverted yield curve would annihilate that number, take down the earnings with it. People were so scared it would happen, you could tell it was palpable. It didn't occur. 10, 15 years ago, the situation would have been real ugly for the big money center banks. I used to trade them pretty aggressively and own a bunch of 9% of some of the smaller banks. This would have been a disaster for me. These banks have aggressively diversified away from net interest income now. They've been pushing more and more fee-based businesses. Why? Because fees stick with you in good times as well as bad. Hey, come on. Yeah, I used an ATM in Mexico last week. It cost me like $7. You press the button. You don't even look anymore, right? Well, confirm. Sure, no problem. Anyway, look at JPMorgan, the best-of-breed operator with a fortress balance sheet that kicked things off when it reported on Tuesday morning. These guys put on a master class in how to deliver even in a supposedly tough environment. JPMorgan delivered a substantial top and bottom line beat. Jamie Dimon today was talking about how weak the economy is, but not to worry. He was right. Net interest income was actually up 2% thanks to an influx of cheap deposits. But it's the non-interest revenue that's the real standout here, up 14% year over year, thanks to strength in fixed income, home lending, and even auto lending. JPMorgan's consumer business is humming with double-digit credit card sales volume growth and record profits. A lot of this, by the way, when the Fed cut rates, it helped. I heard some people talking this morning. It was driving me crazy. So, well, would a Fed rate cut really matter? Did they read JPMorgan's numbers? I mean, like, holy cow. Their investment bank, by the way, is on fire, just racking up fees left and right. Commercial bank and asset management divisions were both effectively flat. Oh, but wait a second. It's not as bad a result when you consider where we are in the business cycle. Remember, I said Jamie Dimon, he's sanguine about the consumer. Obviously, there's some weakness in the business cycle. Look at this. Will you look at this? Isn't this beautiful? Yet, you know what? The stock only jumped 3% on the news. I like it even more after this run. Not only is JPMorgan best of breed, darn thing still, even after this, sells at just 12 times next year's earnings estimates, sporting a nearly 3% yield. That is ludicrously cheap. Hence why we own this one for Travel Trust. You can follow by joining the ActionAlertsPlus.com club. I did a club call this week, and I said, you know what? This is the one. It can do that. It really can. It can break out to the upside. All right, next up, after JPMorgan reported, it's so tough. It's so tough to go after them because it was so good. But that's when Citigroup reported. Citigroup's another Travel Trust name. And it posted a nice top and bottom line beat. It was the kind of result we've now come to expect from CEO Mike Corbat, with modest revenue growth, inline costs, and substantial earnings growth, partially fueled by the company's monster buybacks. While Citi's net interest margin came in weaker than expected, the strength of their consumer business more than made up for it, with a branded credit card revenue in the U.S. up 11%. Numbers weren't quite as good as what we saw from JPMorgan, but Citi stock is so much cheaper, and it's already given back all its post-quarter gains. Right here, the darn thing trades at 8 times next year's earnings estimates, 2.9% yield. More importantly, Citi's a $69 and change stock. $69 tangible book value here. That's what you get if you liquidate the whole company. I mean, I know you're not going to liquidate the whole company, but what it means is that's the cash. That's the cash they have. As I told ActionAlertsPlus.com club members, Citigroup's a buy whenever its stock drops below the book value. In other words, if it comes down another buck from here, you can pounce. Remember, the company's going to be pouncing with you because it's so additive to earnings if they can buy it below book. Now, Wells Fargo reported on Tuesday. Wells is complicated. Black sheep of the banking industry. Revenue beat, sizable earnings miss, But they have to spend fortunes on personnel because of all the problems they had. And this was a noisy quarter with a bunch of big one-time items. So the miss wasn't as bad as it looked. Still, their net interest margin got hammered. It was down 28 basis points. That's terrible. It went to 2.66%. On the call, management told us net interest income would decline by low to mid-single digits next year. Well, thanks for nothing. Here's the thing. Nobody minded the negatives. Why? Because late last month, this company got a coup. Wells Fargo's getting a new CEO, and his name is Charlie Scharf. He is great. He was back in Europe. Before that, he crushed it at Visa. He takes over next week. The bull thesis is straightforward. Charlie is going to come in and turn things around. However, this messy quarter, I think this Scharf might have his work cut out for him, and it's not going to be able to be done instantly. In the meantime, the stock's trading at 11.5 times earnings, 4.1% yield. See, look, that's cheap. All right, it is cheap. But you know what? It is hard for me to get behind it because Citigroup's cheaper and it's putting up better numbers. Still, Charlie will spend more on tech, as he did at Visa, while cutting expenses. That's fabulous. The bank is fat. I won't stay this negative after he has a couple of months under his belt. Last but not least, on Wednesday morning, we heard from Bank of America. That's a disadvantage of reporting after all these others. It gave you inline revenue and slightly better than expected earnings. I've long been a fan of what CEO Brian Moynihan's been doing here. Remember, I call this a tech company masquerading as a bank. That's right. They've invested heavily in best-in-class tech, taking a dominant position in digital mobile lending, which is not just for millennials anymore. Hey, I bank with this. I do. I even know how to use it. What you have to do is you have to swipe up. It's like Stripe or what is that? Match? Well, not really. Bank of America has 38 million digital banking users, nearly 29 million mobile banking users. They're getting tons of business from the web. 40% of the consumer mortgage applications now come from this digital. Swipe left and you get a more. Now, meanwhile, their net interest margin came in at 2.41%. That's down just 4 basis points year over year. Offsetting that, Bank of America racked up some major investment banking fees, solid core loan growth, and they did a good job of controlling expenses. Brian Moynihan is always welcome on this show, not just for how great the numbers were, because the stock's been flying, but for his charity work, which is just awesome, okay? And he can't talk about it, won't talk about it, because he's way too humble, but I'll say it's amazing. The stocks run from 27 last week to over 30 now. At these levels, it sells for 10 times earnings, 2.4% yield, and it's trading at 1.6 times this tangible book value. What does it mean? As much as I like Bank of America, and they are terrific, JPMorgan may be a better buy right here, 12 times earnings. Citi's the better value play. I think this stock can thrive in an environment where the banks are working, but you know what? I'm sticking with JPMorgan for the moment. Bottom line, while the big money center banks face some real headwinds here, they all delivered better than feared quarters, with the exception of perennial whipping boy Wells Fargo. Remember when they couldn't miss? As long as the consumer stays strong, these companies are in terrific shape, and I think the consumer is worth betting on. You've got my blessing to keep paying up for JPMorgan, Bank of America, solid. Citigroup, steal if it pulls back even a few points. As for Wells, why don't we wait and see? Not sorry, Charlie. I'm not adopting a star kiss thing here, but we got to see what Charlie can do. And if he tells a good story, I might have to change my mind and tell you to buy this once best of breed national bank. No matter what, consider this. In one of the uglier days of the year, this group excelled. Who knows where they could go in a good tape? And that's why we're not done. We're going to delve into this group deeper when we come back after the break. Let me swipe right and get a home equity. No, I have the wrong system. Stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.